All right. I think we are good to go. All right. Well, welcome everyone. Welcome to today's edition of the Construction CPA's Coffee Cafe. I am Lisa Raish, CPA. I am the founder of Bodie Business Advisors. We're also known as the Construction CPA, and we're dropping the hammer on cash flow problems for contractors with hands-off accounting services so you can build things that matter. And today's topic is going to be the importance of making estimated tax payments. And the reason that it's today's topic is technically the third quarter estimate is actually due today, which would be September 15th. So I'm going to be dating this live, but we work with a lot of businesses, and so our clients are earning income from a number of different places. So in many cases, we are preparing estimated tax payments for them throughout the year to determine if they're going to, again, if they'll have any kind of income tax payments that they'll have due at year end. So we're going to kind of walk through like who makes them, who doesn't, when you make them, so on and so forth. And we'll go through the importance of them. And if anybody has any questions, please drop them in the chat. We'd love to answer any questions that you have. So basically an estimated tax payment is made when you're not subject to withholding. Or maybe you are subject to withholding in your payroll, but maybe you're earning income in other places, right? So that first time you might have to make estimates is maybe you're working a full-time job and you started to do a side hustle and you have a side business and you're earning extra income and you have withholding from your payroll, but it's just not enough to cover what your overall tax liability will be. So for us, again, we work with a lot of businesses. So our clients typically are earning money from their business. A lot of our clients tend to be S Corps. So a lot of our owners are on their payroll. They may be married. So we have potentially a spouse who's earning some income. They're earning income from the business, maybe rental properties, maybe a brokerage statement. So some capital gains, dividends, things like that. So basically we're calculating the income tax liability that we think is going to be for the year. And then if there's an offset, again, some clients do have payroll. So is there payroll withholding? If there's payroll withholding, we kind of offset it by that and then determine what we think the ultimate liability will be. And we want to make those payments on a quarterly basis. And again, small business owners, it's beneficial for you to make those estimates. There is going to be arguments from I've had clients over the years, there's an argument that they'll want to hold on to their money throughout the year and they'll just pay the penalties and interest at year end when they have their balance due. Where I see a lot of people get very caught up is they don't put the money to the side. And therefore, when that balance comes due at year end, when we file their tax return, they don't have the cash. So you're going to get charged penalties and interest if you underpay throughout the year. So that's one of the things that you want to think about. And we'll get to that a little bit farther down, that you could potentially incur penalties and interest for not making an estimate and, the required estimate. But if you don't pay at least 90% of your tax liability from the prior year, then you're going to incur penalties and interest on what they call underpayments, right? And so once you hit specific AGI, so adjusted gross income levels, once your income gets to, and I apologize, I don't remember what the number is off the top of my head. It actually needs to be 110% of what you paid in the prior year to kind of eliminate the penalties and interest. But so, those that most likely want to and should be making quarterly estimates are going to be your small business owners, right? Those that are filing a Schedule C, the sole proprietors, those that are subject to self-employment tax, freelance individuals, independent contractors. And then also from our perspective, the business owners that we do business with, right? Again, many of our clients are filing as S Corps, whether they're LLCs filing as S Corps, so they actually are S Corps. Many of them are on payroll. They do have withholding from the payroll, but if their businesses are profitable, which is the goal, the thing that we look to help them achieve is a profitable business, they're going to have an additional tax liability on top of what it is they've had withheld from their paychecks. So it's far easier to budget on, a weekly, monthly basis, your estimates, your estimated tax payments, and put it to the side, versus having to come up with an entire balance due, which if you are a profitable business and you are doing well in your business, I've seen very easily clients have 10, 20, $40,000 balance dues at year end. And if you don't have that money easily and, pull it out of a bank account and make the balance due, that's where you run into your challenges. And, you may find that you may need to get into an installment agreement in order to kind of repay it. And of course, you're incurring penalties and interest for every day that liability still sits outstanding, even if you are in an installment agreement. So it's easier to budget your estimates in. A lot of times we, give clients just we make a recommendation. This is not a fail safe, but this helps by taking a percentage of every dollar that you bring in the door, and you budget it and you put it to the side, and that becomes the dollars that you have in order to make your estimates when you need to make them on a quarterly basis. Again, it just makes it easier for you to meet that tax obligation. Filing that return in, February, March, April can be very scary if you have a very large balance due and you don't have the funds put to the side to pay it. So, budget that money on a monthly basis, put that money to the side, and then every quarter you make those quarterly tax estimates so that if you do have a balance due at year end, it's a minimal one. It'll be a small balance compared to, what you actually could have owed had you not made the estimates. So when are you making estimates? So you're going to be making estimates on the 15th of April. So that's Q1. Q2 actually falls in June. So the Q2 estimate is June 15. The Q3 estimate is September 15. So just before the end of that Q3. And then your last Q4 estimate will be due in January of the next year. So they're not perfect 3-month quarters. So you want to keep that in mind. And then the last one is made at the first part of the next year. So when you're thinking about your budgeting and you're putting your money to the side, if you have some sort of balance due with your return in April, keep in mind you would potentially have a balance due if you have one. And then you also want to make, so it would be for that prior year liability, but you're also going to be making that first quarter's estimate, in April. So for a lot of clients, that first quarter, that first part of the year can be a significant dollar outlay, something to kind of think about as you're budgeting your money and you're putting it to the side throughout the year. You want to think about if you didn't allocate enough for the prior year, when you go to make that first estimate in April, it could be a good chunk of money. But again, if you're budgeting and you're putting the money to the side, it's not as scary as a proposition. The money's in the account. And from our perspective, we are running a calculation for our clients. So typically, you have the ability to pay estimates based off of the prior year. So most tax softwares will provide you with estimates for the next year if you are potentially, on the hook for additional tax. In our case, we tend to run as much of an accurate number as possible. So we're taking actuals out of their business, forecast of what we think they're going to do in the balance of the year, and kind of getting more of an actual number for them versus using the invoice, the estimates to kind of pop out of the tax software at year end, especially when you have a client that's in growth mode, businesses are growing, they're earning more revenue, more income year over year. So we expect the income to be higher than the prior year. So that just puts us in a place where we're getting as accurate a possible of an estimate as possible. That's not to say that's not the only way to do it. It's just the way that we happen to do it for our clients. It's easier to have a relatively accurate number through the year so that we truly if they do owe anything, it might be a small variance based on something maybe that happened right at the end of the year that we weren't aware of, or something that's kind of fell into play in their finances that we may not have considered in our estimate. But the idea is we want to try and get a client as close to we'll call it a break even, right? You get a couple dollars back, or you owe a couple dollars, not clients owing $40,000, $50,000, $60,000 because they had, a good and profitable year. So you can make your payments online. So you can go to irs.gov and make your estimates online. You also have the ability to make your estimates through EFTPS. It's, I don't know, electronic funds transfer process system or something to like that. It's for Internal Revenue. It is, it's going to go towards your federal estimates. So instead of going to irs.gov and making a payment every quarter, getting your confirm number at the end, this is more of, you actually have a login. You go into the login that's yours, you make your payment through there. It kind of tracks it through there. EFTPS, again, allows you to kind of track the payments that you have made in the past versus with irs.gov, I believe unless you have an ID.me account set up, you can't go back into irs.gov and just look to see what estimates you've made previously. So I like EFTPS because it does keep track of it. It's not the only option. Again, you can go directly to the federal website, or you can go through EFTPS. Don't forget, if you live in a state where there is income tax, you want to make sure that you calculate and figure in any kind of state income tax estimates that you might need to make. Again, most states now are do have an electronic portal where you can go in and make a payment. They still accept the coupon. So you get, when you print up a tax return and you get those coupons from that printout, they will accept your paper check. They will accept the coupon. So you can mail your paper check and your coupon to your local state tax authority, to the IRS. They will accept it that way. Like anything else, the check goes in the mail. You have to wait for it to arrive, for them to process it before it clears your bank and so on. So what I like an online, you get a confirm number, and typically within the next day or so, it sweeps out of your bank account versus mailing a check. And then you have to think about whether, kind of, did it clear your bank? Did it actually arrive through the post office and so on? So I personally like an online. Some people still like to mail checks. There's nothing wrong with that. They will still accept your money that way. And again, for us, with our clients, we run a relatively accurate as we can be. So we're taking current business results and we are looking at their forecast for the balance of the year to determine what we think they're going to have earned in their business, what they're going to have earned on their salary, so on. And we're running relatively accurate estimates for clients. So again, so we can get to more of that break even at year end. So kind of some misconceptions about estimates. So estimates, extensions, kind of everybody thinks of a lot of those things as interchangeably. So when you file your extension in April, so on April 15, you file your extension. Technically, it's not an extension of time to pay. It's an extension of time to file. So you should have made your estimates throughout that year on April 15, June 15, September 15, and then January 15 of that year. So you're just asking for more time to file that return, not more time to pay it, because you've made your estimates throughout the year. So again, you want to think about that, because now if you have not sent money with you, so now you run an estimate, right? You run the numbers and now you realize that, oh, I didn't make enough estimates throughout the year. When I file my extension, because I do need more time to file, when I file it, I really should, I really need to send more money with it because I'm actually going to owe. That balance, you really need to send with it, because again, you're going to rack up penalties and interest for underpaying your overall income tax liability, for that year. So something to think about. It's an extension of time to file, not to pay. Another misconception, this happens a lot with people who are 1099 freelancers, independent contractors, things like that. You do not have any withholding from a payroll when you're a 1099 individual. So just because you didn't get that 1099 doesn't mean that you don't need to make those estimates throughout the year and that you don't need to report that income. You, in fact, still need to report that. So again, it's a misconception that, well, just because I didn't get the 1099 at year end, I didn't have to make estimates throughout the year. I don't have to report that income. It's not income taxable. No, you still earned that income. You are responsible for keeping track of what you've earned from that particular contractor. Maybe you're working for multiple contractors, so you need to keep track of that and report that income, and then, again, potentially pay self-employment tax and then income tax on that. So something to kind of think about. A misconception is that you can pay all your self-employment tax at the end of the year. Yes, you can, but you're going to incur penalties and interest on it. And that's just the reality. It's going to cost you more money. And so if you're not making a lot of money on that, it just doesn't. I've had clients over the years, and it becomes a personal thing. Yes, you should be making your estimates, but I've had clients that would rather, if they have $100,000 tax liability for the year, they'd rather hold on to that money. They feel like they can do something else with that money throughout the year. They can earn more on it, make more, build, increase their revenue base, whatever the thought is. It can be a way for you to get yourself in trouble, to be completely honest. Not paying your estimates throughout the year, it can be a very big dollar balance at year end. And so if you don't have the capacity to come up with the money for that, it becomes a very, very expensive endeavor. So I very highly recommend that you make your estimates. I know I made my Q3 estimate already. I figured out what my, I think my liability is going to be, and I made my estimate. So again, last year I had, I think, a small overpayment. So I rolled it into this year because, again, every year I'm making estimates. So again, I make those, I take my own medicine. I make my estimates, just like I recommend that my clients make their own estimates. Don't put it off. Oh, I'll have the money next quarter. If you have it now, send it now. If you have it in the middle of July and you didn't have it on June 15, send it in July. Yes, you should have sent it in June, but send it when you have it, because I've seen too many times clients have kind of the ebbs and flow in cash, expecting to have cash at a certain point, and they just don't. So again, don't put it off. If you have it now, if you've come into a large sum of money, you expect you're going to have a liability, and if it's not the absolute estimate date, send it in anyways. Again, keep safe than sorry. You don't want to worry about, owing a significant amount of money at year end with penalties and interest. And, oh, by the way, you don't have the funds any longer. So again, something to kind of think about. I've seen kind of across the gamut throughout the years, again, clients who hold their money all year and will have no problem. They're like, no, I'll send $100,000 at year end with my balance due. They don't care. Others want to make estimates throughout the year. I do personally. So again, I highly recommend that you make your estimates. There were some tools online. To be completely honest, you can Google self-employment tax calculator and you're going to get a whole slew of them that'll pop up. So there are plenty of resources on the internet. If you are working with a tax professional, I would think about, if you are self-employed, if you have a business, a pass-through, I would recommend that you, think about running relatively accurate estimates so they can get as close as possible, versus kind of being over or under for the year, depending on where you fell. I believe it might still be in there. Something like QuickBooks Self-Employed. It might be QuickBooks Simple Start now. I'm not sure. They might have changed the names. Anyways, previously, with that particular product, it would calculate kind of what your self-employment tax would be. Like you look in the top, I think it was the top right corner of the app when you opened it. It would run like a quick calculation for you. Again, simple tool to kind of help you get as close as possible. I do know, like, some of the other products out there some of the other software, some of the small kind of self-employed business tracking products will have that in there. That's there to help you as well. So if you have any questions, please, feel free to reach out to us during the week. Drop your questions in the, in the comments below. We'd love to, get back to you, answer anything that we can. Again, it is best for you to make your estimates throughout the year. You want to try and stick to the calendar of April 15, June 15, September 15, and January 15. But if you can't, when you get it, put the money and send your estimate in at that point. You will be in much better shape come tax deadline than you would be if you waited to make that entire payment at the balance due when you're incurring penalties and interest. So if you, liked what you heard today, please come back, join us next Friday at 10 a.m. for the next Construction CPA's Coffee Cafe. And if you love us, again, drop, hashtag coffee break in the comments. Again, please feel free to drop any comments, questions. We'd love to answer, point you at any resources that we potentially can. And again, remember that we are dropping the hammer on cash flow problems so you can build things that matter. Have a wonderful weekend, and we'll see you next week.